In today's segment, we're going to be talking about trusts and the benefits that trusts can offer investors. Before we go any further, I think it's important to say that what we're about to go through now, it shouldn't be considered as any financial advice or legal advice or tax advice. It shouldn't be considered as any advice whatsoever. This is just information that we're going to be providing about trusts. To help us with this, we're going to be speaking with a barrister, a doctor, and a chartered accountant. And his name's Campbell Rankine. There may be some legal jargon. There may be a lot of legal jargon in this interview. So you may want to put your helmets on, strap yourselves in, and have your legal dictionary beside you, because I think we're just about to see how a barrister does extreme sports. Campbell, thanks so much for making the time to speak with us today. To get the ball rolling, can you tell us a bit about yourself?
Yes, I'm Campbell Rankine from my own firm, Campbell Rankine. I practice wholly in the field of taxation law, predominantly in the field of taxation of trusts and stamp duty on trusts. Hold a doctorate in taxation law, and my thesis topic was the taxation, broadly on the taxation of trusts. It was called the disutility of assessing trust beneficiaries on incomes derived by their trustees. And this built upon previous degrees I've done in tax law, particularly on trusts, and this has been a progression of a number of years. I practiced originally as a chartered accountant for 20 years and moved out of that into tax law when accounting for trusts became just too complex for accountants. And that's where I practice now as a sole practitioner.
Okay, so how long have you been a chartered accountant, solicitor for?
Well, I've been a chartered accountant for 20 years and a solicitor for 27 years.
So Campbell, to get the ball rolling, how about we talk a bit about the basic trust structure?
Right, there's a protean variety of trusts in commercial use and operation. The most restrictive from a CGT point of view is the unit trust, and is generally not to be desired as the owner of property, or at least capital appreciating property. Then we have the standard, or what's known as a standard discretionary trust. It's a non-fixed trust where beneficiaries don't have fixed interests. And then we have the hybrids, most notably class trusts, and I'll deal with those in just a moment. The unit trust, as I say, is not well suited to ownership of capital appreciating property, and that's chiefly because of the inability to pass tax preferences back to unit holders other than in indexation, small business CGT exemption, not the concession, but the 50% concession. That alone can be passed back without tax implication, but small business CGT concessions cannot be, and nor can straight corpus distributions unless the trust has very large amounts subscribed as corpus. So in a typical unit trust, there is a person who settles it with a nominal sum, $10, $20 or something, and any distributions of corpus out of unrealised gains, or even realised gains that have been subject to small business CGT concessions, will trigger a deemed capital gain under CGT event E4. That's not a problem for straight discretionary trusts, non-fixed trusts. In trusts of that kind, if we look at our typical discretionary trust, if there is a typical discretionary trust, you have a settlor, one who makes the gift, much the same way as it is in a unit trust. You have a trustee who's possessed of trust property, often just a gift to start with, but then uses those proceeds, plus other monies, to purchase real estate or some other capital appreciating asset. And the beneficiaries on whose behalf that property is held generally form a class of people. If it is an individual only, then it won't be a discretionary trust, or at least not for the purpose of this discussion. It might be for other purposes, for example Section 101, but it's not for the purpose we're talking now, as a desirable vehicle to hold property. In the case of a class, the class is generally, in most modern trusts, by which I mean trust in the last 20 years, has been for a class of people with a power to the trustee to select which of them shall take the trust profit or the trust property, as the case is. Now, it is, in the case of what's called trust powers, which I've just described, it's a trust for distribution of property amongst beneficiaries with a power to the trustee to select which of them shall take. If there's a gift over, that is, if the trustee doesn't exercise his discretion, and it goes automatically to a class of beneficiaries or individuals, that class must be a countable number and therefore would take in some discrete proportions. That used to be how discretionary trusts were drawn in the past, but is somewhat undesirable today. Even then, with gifts over, they won't be subject to CGT Event E4. The Commissioner's made a ruling on that. The hybrids, as the name connotes, are a range of trusts. That is, everything that is neither a straight non-fixed trust or a straight unit trust. The most popular type, though by no means the only type, is a class trust. And this is a trust for division of profits and property amongst beneficiaries in discrete combinations of groups of them. So if you have Blackacre held as trust property and you distribute Blackacre's profits, a class trust will typically say that the profits are divided between the groups in some preordained proportion, and within that group, each group, in a complete plenary discretion. So you might have several families or several children in a family, each comprising a group, but within each group there is a discretion. So if there are several children of one family, then those children will effectively have power to determine within that child's own family and his trust and companies without sullying the decision-making and plenary authority of other beneficiaries, other children. So it's much akin to a unit trust having discretionary trusts as beneficiaries, because the percentage between each class is fixed, but not fixed, in fact wholly discretionary within each class. And that supplants what used to be a fairly typical structure of having a unit trust with a discretionary trust below it. That's been around for many, many years. Certainly not an efficient vehicle because of CGT Event E4, and certainly not efficient for stamp duty purposes. Both from the point of view of having to value each time anything changes, and second, a unit trust is a land-rich entity for stamp duty, so the land-rich provisions will apply to unit trust much more readily than they will apply to a straight discretionary trust. Now, as I say, there are more than one hybrid trust, and I've just described a class trust. Others are discretionary unit trusts, where the trustee has a discretion to distribute to some only of the unit holders, not to others, but only to unit holders. So it's not necessarily to be made in the unit holding proportions. That's often been used in the past, and it's been used where there is some mechanism to avoid what's called value shifting. That's not a problem that arises with non-fixed trusts, but it is a problem that arises with fixed trusts like unit trusts. So discretionary unit trust is often one mechanism of avoiding that unnecessary complication, just as having differential dividend powers in companies can accomplish the same thing for companies. But broadly, they're the three categories.
Campbell, you mentioned the settlor, the appointor, the trustee, which can be a corporate trustee as well, and also beneficiaries, and you have the trust itself.
Yep.
Can you define what each one of these are?
Yes. A settlor is one who is not a beneficiary, but is prepared to make a gift, often a very small sum, to a trustee, who we'll come to in just a moment, to establish the trust. It is necessary for him to establish the trust, and there are good reasons why the trustee doesn't itself do so, although in some occasions it will, so that the gift binds the conscience of the trustee and creates the trust by that binding of conscience. So the trustee accepts the gift and that acceptance creates the trust when the cash is paid across. That's the settlor. The trustee is the one with fiduciary duties, that is a duty of utmost good faith. He is possessed, or she is possessed of property, originally coming from the settlor, and bound to hold that property for the beneficiaries under the terms of the trust, or in some cases for specific purposes, charitable purposes, for example. But in the trust we're talking about, which are called inter vivos trusts, that is, trusts made during the life of somebody, that gift is to be invested by the trustee using utmost good faith for the benefit of the beneficiaries, or technically the objects of the trust, who are the beneficiaries.
When you talk about gift, you're not actually talking about the properties themselves, obviously. We're talking about the nominal sum that the settlor...
Yes, it can be a whole property, but there's considerable stamp duty if you do it that way. Far better it is for the trustee to make a gift of a nominal sum, and stamp duty is paid on that in South Australia. A gift of a nominal sum, and the trustee, in use of that gift and bound by the conscience that that gift attracts to him, will then inevitably borrow money to purchase a piece of real estate or some other asset that forms part of the trust property. In olden days, and I go back to some years back now, it was important when we had death duties to ensure that the gift actually became part of the real estate, but that's no longer the case with the abolition of death duties. So now we have just a small amount of gift, $20 or something of that kind, often by the accountant for the principal beneficiaries, who establishes the trust on the trustee, and the trustee is very likely to be one controlled by the beneficiaries or the principal beneficiary, and the shares in the trustee company are likewise generally to be held in the same way. Now, the beneficiaries are often a class of one family. If there is more than one class, that is a class that is coextensive with another class, that is, they side by side, then there's usually a mechanism in the trustee to decide how much each class will take. More likely, or at least more traditionally, but not so commonplace today, is where there is a class of general beneficiaries, as it's sometimes known as, amongst whom the trustee selects for benefaction, income distributions, capital distributions, any corpus reductions, and all sorts of property transfers, conveyances and dispositions of property. And if the trustee decides or doesn't act by 30th of June of each year in the case of income, it will go automatically to the next stage or next tier of beneficiaries. That's where you have secondary beneficiaries. But as I say, that's not a trust power. That's the older form of trustees, which are very little used today as a result of a 1971 House of Lords decision. So that's the beneficiary, the range of beneficiaries. The trustee's duties here, and the trust I'm describing, is to use its utmost good faith in deciding which of the beneficiaries, and he must do that singly, it's not a group, he must singly decide which of the beneficiaries is most worthy of benefaction. Now in practice it's usually often just driven by the correct tax result. It's achieved by the distribution. But in equity takes a stricter view, and that is the beneficiaries so selected must be worthy and to warrant the distribution made to him or her or it. And in that process, the trustee is discharging its fiduciary duties as a trustee in exercising that power of appointment.